All right, we're going to dive into the payment cycle today for our auditing review. So let's go through the five major functions of this whole payment cycle process. They don't always exist at every company, and I'll go through that in a minute, but you've got a purchase requisition, which is put together uh, for getting approval to buy something. Then ultimately, a purchase order is released to go to a vendor to acquire that goods that have been approved. So there's your approval process. They could be handwritten documents. They could be a mixture of printed documents and handwritten documents. They could also be electronic with electronic workflow or approvals that happen through a system like a larger system like SAP. So that's the purchase requisition purchase order. Then when those goods come in, they're received and there'll be a receiving document related to that. And then the vendor will send an invoice. You'll get that invoice, and ultimately you'll pay that invoice as long as everything has matched. And that's what this three-way match circle here means, that usually there's that three pieces that will allow a payment to happen. You've got the purchase order, which says what you're going to order and what you thought you were going to pay, the receiving document, which should correlate to the purchase order and that you ordered some items, you should receive those items. And finally, you get invoiced for those items. That should be at the price you thought on the purchase order and that the quantity that you receive. So that's what's called the three-way match. Now, where I said that this whole process can be a little bit different is some entities may not have a purchase requisition. They may start out with a purchase order. Some may not even have a purchase order system. Some of the smaller companies, they may just order things and receive an invoice and pay it. So it may just be the last two steps there is all they have. So it depends on the entity you're dealing with, how big they are, what type of system they have. So these are all important things for the auditor to understand. And finally, my last point is on the invoice and payment. Usually that will require, again, a written or electronic approval. And a lot of times that comes from the accounting or finance area as far as do we have the funds to actually make that payment right now. Later on in this, I'll show you in QuickBooks how people determine whether they have the funding to actually make payments or have cash requirements met. So what are the main accounts that we're talking about in the payment cycle? Well, usually payables is the big one right there in the middle. How do things get to payables? How do things get relieved from payables? Well, first off, we're going to buy inventory. We might buy insurance ahead of time. We might buy operating items and supplies and selling administrative items. We might buy things for the manufacturing process and manufacturing overhead. All these things will be bought and acquired through that purchase order process. And when they're received, they ultimately will create an accounts payable that's owed to a vendor. Now you'll notice I put a couple terms there that you should know for the real world. One is trade payables. Trade payables usually mean anything we do for the trade or operation that we've got. So you might not see accounts payable, you'll see trade payables. There's also another account that some systems have that you should be aware of. When goods are received, but the invoice has not come in, there's an accounts payable account called received not invoice. So it's the amount of liability that's the company may owe based on purchase order numbers, but an invoice hasn't come in yet. So it's kind of an important thing to note there again that you don't necessarily have to receive an invoice to have a system automatically record a liability because it will do that based on receipts. And then finally, we can relieve accounts payable through cash checks, EFTs, electronic fund transfers to vendors. A lot of auto pays are going on now. A lot of auto pays are being set up. I just want to make sure all that's correctly done up because you don't want any auto pays going to your employees. Discounts and rebates for accounts payable could be applied and actually reduce the account. You could also have some product returns that would also reduce that accounts payable account. We've got our audit assertions and we'll apply those to accounts payable. So you've got Existence, does that accounts payable balance actually exist? More, we're worried about completeness. Have they included everything in there? Does the balance include all transactions that have taken place? Don't want any missing accounts payable, so you'll be searching for unrecorded accounts payable, and we'll go into that step in a little bit. So part of that is making sure you have the proper cutoff periods, and when you're looking at invoices, making sure that if it's a January, December, is the portion that was for the next year into next year's financials, and is the portion that was for this year's financials in this year's financials. So cutoff periods on invoices is very important in the payable process. Rights and obligations, is that truly an organizational debt? Make sure it's not paying your employees electric bills and things like that. Valuation and allocation is also important because the recorded balances that truly reflect the outstanding value of those liabilities, because sometimes you'll see a payable booked or a liability booked. Does it actually really reflect that liability that winds up getting paid later on? Presentation and disclosure is always important related to any of the balance sheet items. Inventory assertions. So a lot of important things in here when it comes to inventory. First off, existence. Is that inventory actually exist at the balance sheet date? Is it really out there? Next would be completeness. Do we have all the inventory transactions included in our inventory account activity? Do we have rights and obligations to that inventory? Is it ours? Is that consigned inventory that someone else has given us to sell? Do we have consigned inventory that's out somewhere else that we need to make sure is included in all of this? The valuation method is also very interesting topic, because on really large multinational companies, you could have several inventory methods. Smaller companies and medium-sized companies, you might have one main method, and we'll go about talking about some of those inventory methods in a little bit. And then obviously you want the presentation disclosures related to inventory. Like I said, some of those multinational publicly traded companies will show that they use several different inventory methods depending on which geographical location, which type of business segment that they're talking about. So all these things factor into inventory. So the inherent risks of the payment cycle include the following, especially related to inventory. You've got material in dollar value, could be a ton of dollars in inventory. You'll have those multiple and alternate valuation methods that we just discussed. You'll have complex and diversity. So think of contact lenses, all these little tiny contact lenses that are in boxes. So you've got a type of lens, which could be some specialty type of lens that you use, and or some common lenses. You've got all of these different types of lenses. But then you've also got brands. So if you're a warehouser that sells all sorts of brands, you could have lenses from the different manufacturers, those different types of lens that we talked about, and then think about all the multiple prescriptions and pluses and minuses that people's lenses can have. So you could have thousands and thousands of items that are all being tracked from an inventory system. So that's a complex and diverse side of inherent risk of the inventory. Now, there could be high volume of activity, just like I talked about those lenses. Tons of lenses going out everywhere all the time to different customers. You could have obsolescence, so there's obsolete inventory that nobody's using anymore. The best way to identify that when you're doing a walk around is the dust that's collected on those boxes. It can easily be stolen. Inventory, in fact, when we're talking about the contact lenses, you know what a box of contact lenses would look like. You know how easy that would be to put into someone's pocket, and they could steal it from the warehouse. You might have multiple warehouses and multiple locations. Consignment it maybe hundreds of locations. So these are all inherent risks in the inventory side of the payment cycle. In the accounts payable cycle, invoices can be ignored or not properly reflected on the balance sheet. So all it takes is someone to put an invoice that they don't want to reflect on the balance sheet in a drawer and hold on until after the auditors leave, then bring it out and pay it or enter it into the system. Classifications of assets and expenses are done properly, and management could hide expenses as assets to try to make the financial statements look good. So you're going to be looking at those classifications of the payables that are entered. Now, related to fraud in the payment cycle, you've got all sorts of disbursement fraud that's out there. Some of the main ones you'll see are fake vendors, or also known as shell companies, where someone has the ability to set up a fictitious vendor in the master data, probably put their own address or their own bank account as far as where the payments go, and then they'll create fake invoices that get paid, uh, and they likely do not require that three-way match that we talked about earlier because it might be a service. Remember, there's no goods that are received on a service invoice. So you get an invoice, someone approves it, puts it into the system, and it gets paid. If someone's really conniving, they can tell someone to set up that vendor, approve that invoice, and they've essentially approved an invoice to pay themselves. So there could be theft of inventory by an employee, like we said before. So if you see significant number of manual adjustments in the inventory or excessive inventory shrinkage, then it's likely that you've got some sort of theft of inventory going on. There's also the financial schemes of reclassifying expenses as assets to make the books look good. And then also, an employee could procure personal items through the corporate expense accounts. And unless you track those expense accounts, you might not find out that an employee has bought personal travel or bought personal items through the corporate account. Financial statement fraud in the payment cycle are reasons why people might manipulate uh, their financials through the payment cycle are they want their bottom line to look good or their gross profit to look good. So they may want dollars out of their cost of goods and into their inventory. So they may overstate their inventory in a way that makes their cost of goods look smaller so that they look more profitable. They also may want to overstate that inventory for debt covenants that they have out there. So they might have some financing through a bank that says, hey, you've got to have so much in inventory to back up this debt that we are giving you, and so they might want that inventory to stay inflated to back up that debt, and you might have some bad inventory numbers in there. The flip side of that is they may be paid upon how well they're turning inventory over, so they want inventory to look smaller and lower. So that could be a manipulation. So it's really important to understand what the management drivers are that's important to them, and that might lead you to if there is a financial statement fraud going on. So let's talk about some of the different areas. Unrecorded purchases. You've got a big purchase that comes in, you received it in, but you don't enter it in the system. So when you're out there looking at the inventory and you see this a lot sitting there on the docks and not taken and put into the inventory system, it could be a year-end manipulation to keep their inventory numbers lower. So that's why those cutoff issues are very important. Also, when we're looking at invoices, and potentially we might want to lower our inventory by recording product that we're going to return or that did get returned after year end, but record it early so it makes our inventory look lower. So that's another area that could be up for manipulation. Valuations are kind of a big deal because people can alter certain types of inventory valuations throughout the year. They can make their inventory amounts look lower because of that. They can also purposefully miscalculate the inventory method or alter costing methods throughout the process. So you've got to be aware of those situations, especially in material items or significantly moving items, so that you make sure there's no manipulation there. They could be manipulating it related to that debt covenant also, trying to make the inventory look higher value than it is. obsolete inventory, if you leave obsolete inventory in there, it's really misguiding the reader of the financial statements as to the real true value of your inventory, since you're never going to be able to sell it. Now, especially if you're keeping it at the high value that it may have been when you first got it. Now, if it's obsolete, you've either got to write down that inventory value or write off that inventory. You might leave it on there to manipulate your financials if you want the bank to think you have good inventory in there to back that financing. And finally, you may double count inventory, especially if you have a periodic system. If you accidentally double count inventory, you'll make it look high when it really shouldn't be high. And this is why I always say the gross margin percentage is a great test, because if it's had significant change in the percentage, that's an identifier that there's been some sort of manipulation of inventory or cost of goods sold data. So when we talk about the key controls related to inventory, we want to make sure that purchases are authorized. There's some sort of process in place to authorize purchases of inventory, and other items for that matter, but inventory in this case. Timely and accurate recording of inventory transactions. They're happening as they occur, usually, if you've got a perpetual system, which we'll talk about, making sure invoice entries are happening. These things are all going about so that the transactions get reported timely and accurately. Proper costing system for inventory. This is kind of a big deal, and it's more of a complex area where you can get into some really complicated inventory costing systems. So we'll talk about inventory costing systems again on another slide, but authorized process for changes, especially to any master data related to the inventory. And we remember master data is the setups, the costs, uh, those types of items that make up the components of what that inventory is all about. Is it consistent in a comprehensive costing process? And any variances are analyzed, and you'll remember your variances from managerial or cost accounting. So comparing those standards versus actuals and understanding why there's some variances. Making sure that you have a reliable inventory cycle counting system. So those are some of the basic controls. Obviously, you can add physical controls on there to make sure that key inventory is locked up. Some inventory might be specialized in the sense that it's got to be at 75 degrees or lower, or else it'll be damaged. So those are other controls that may impact your inventory related to the specifics of inventory. So a quick basic inventory refresher, you've got the periodic inventory system where we don't record those inventory transactions daily. We record our purchases of things, but then at the end of the month, we'll do or whatever period we're using, we'll do a physical count of that inventory and adjust that inventory balance to whatever that actual physical account is. That's a periodic inventory system. Now, perpetual inventory system keeps track of the running tallies of inventory. So you'll have the ability to see on any given point in time what the inventory levels are. So they book their transactions in inventory either immediately after transactions, so you'll have this electronic inventory count that's always available and always happening. It still requires periodic inventory accounts to ensure transactions are being done correctly. So you still need those cycle counts. There could be a batch process. And what a batch process means is the systems don't always talk. So there's some sort of point when you run a batch that they wind up integrating their data together. So sometimes that can happen at night, or it could happen periodically throughout the day. It could be like a lunchtime batch process or whatever. It depends on, again, the manufacturing system, how big the company is, all those things. In some cases, manufacturing records are immediate and they'll update it immediately, but they don't talk to the accounting system until nightly or weekly or whatever the process might be there for batching. So both systems need to have a regular review for obsolescence and for inventory stocking levels to prevent shortages or excess buildup of inventory. And also you want to correlate that with the demand of the customer. If there's not a lot of demand, you shouldn't have a lot of inventory. So that's where your inventory systems come to play. When you're doing your typical control risk assessment questionnaire, you're going to ask questions like, are purchases of inventory approved at a proper level? Is there adequate documentation? Are things pre-numbered so that there won't be any missing purchase orders that somebody could have taken home to try to figure out a way to buy stuff for themselves? Are purchases of inventory made from an approved vendor list? Back to that vendor master data. Are changes to the approved vendor list approved? Does the company have a formal policy and appropriate oversight about the nature of appropriate vendor relationships and gifts? Can your employees accept gifts, having a vendor buy them lunch, things like that? What's the proper level? Are controls over the process of handling return goods adequate? Is the recording of purchases made in a timely manner? Is the recording of returns made in a timely manner? So part of that planning process is doing your analytical ratio and trends. And so again, gross margin analysis is a big deal, making sure that there hasn't been significant changes. Looking at inventory turns and number of days that sales are in inventory so that you know that when something comes in, it might take 90 days before it's sold. Shrinkage ratios, again, that's a problem if that's increasing. So you've got a few other trends there related to inventory ratios. Accounts payable ratios, you can look at the accounts payable turnover, how quickly are they paying their payables? So that's what days outstanding in payables would be, and a couple other ratios that you can use. After we've done our analytical procedures and we start to get into the substantive tests, especially for inventory and cost of goods sold, you're going to select some inventory items. Is the inventory count correct? You may require cycle count observation, may require visits to multiple warehouses or major consignment sites as part of that, depending on what your role is. It could be an internal auditor, that's what you would do. External auditor, you might have a different process related to that. Is the value correctly and consistently calculated for how it rolls up to the inventory value on the sheets? And then does it go to the accounting system properly? You'll want to review some invoices from vendors or any contracts that are out there just to make sure that the value is correct there also. And is that truly owned by the client? Is it on consignment? Is it a bill and hold? So you've billed it, but you're holding it, so you don't want to include that in your inventory. And again, you're going to make sure that it's a true bill and hold. And then identify any obsolete inventory. Those are kind of the major tasks of getting into your inventory and looking at it and checking on it. So you're likely going to be doing an observation of an inventory count if you're an external auditor. Doing it internally, you might review the documents from an internal audit perspective, but you want to make sure that you have all the inventory listings and they all tie out to the general ledger balance, because that's how you determine whether if you have all the listings or not. So then you plan for the observation of that inventory count. You make sure that every inventory item that needs to be emphasized is put in that observation. You review cycle count procedures, how they do it, what their process is. Like some places have what's called an ABC method. The A items are the items that get used frequently. They cycle count those more regularly, sometimes daily, sometimes weekly, sometimes monthly. Then you'll have BC items. C items rarely get used, rarely get counted. Of course, those are the ones that I know for my obsolescence review. Determine if specialists are needed, because you could have some sort of special chemical or product or something that you as an auditor may not know how to really figure out the measurements for that. And so sometimes you might bring in a specialist or just ask a specialist some questions related to that. Plan for whether the warehouse or plant will be shut down or is it still operational, because that impacts it. Think about it. If you've got a warehouse that's got 24/7 shipments out to clients and you have to, or to their customers, and you have to go in there and count that inventory, you're trying to pick the time period to observe that when there's the least amount of activity. And even then, because there might be some activity, you've got to factor that activity into your count. So ideally, you shut down, you do the count. That's why you'll see a lot of this happen right at year end. So as much as people are going out to party for their December 31st Happy New Year's, you might be doing an inventory count. So the exciting life of an accountant emphasized by the inventory count. So you're going to observe that inventory count and make sure that the documents related to your work papers are correct with all the items, the counts, the unit of measures. Make sure you've got the right unit of measure on the items that you're looking at. And so then you'll be able to note any obsolete inventory or excessive inventory through that observance, and then you'll develop your conclusions on the audit plan. Let's do a quick review of those costing systems for inventory. You know LIFO and FIFO, an average costing from managerial and cost accounting processes. So LIFO, last in, first out. Sometimes I've heard of it called FISH, first in, still here. Sometimes that's easier for people to understand. Same with LIFO, first in, first out, which can also mean the last in is still here. So you'll also remember average costing, which could be comprised of a weighted average. It could be a perpetual average, but know that some systems are set up to take like the last 5 purchases to figure out their average. So this will depend on what your system can do. But one thing you don't really talk about, as much as in managerial and cost accounting, you talk about standard versus actual. Standard costing systems are how a lot of accounting systems are developed, where once a year you put the new cost for those items out there into the system and it calculates variances the rest of the year based on those costs that you started at the beginning of the year. Now, standards are not really supposed to change much, so they rarely change, but occasionally you come across that situation where there's just a significant variance that's constantly popping up from one particular costing model that was either input wrong or just has had significant changes in pricing and whatnot. So you'll do what's called a cost roll. Cost roll means it's going to roll through all the inventory and re-add it and revalue it. So there's a couple ways that rolls happen, and it's important to understand the procedures and allowable procedures related to this by your company. But you could do a full cost roll where it just goes through every inventory item and revalues it based on the changes, which you could have major items that you're changing, but then you might have made some minor changes. It's going to accept all those and just put them all in and roll the cost up together. So you might have what's called a partial cost roll, where it just takes specific items or specific product groupings and it will just revalue those. So cost roll is probably a term that you haven't heard much, but that's something if you get into the manufacturing area, you're going to hear quite a bit related to the standards. And then an auditor should obtain the procedures and how that costing system is supposed to work and how it's supposed to be administered, how it's supposed to be updated. And that's important for the auditor to know. And then we're going to test that cost system and then document the results. For substantive tests of accounts payables, the big one is really the cutoffs. Are you recording everything at year-end payables that should be in there? So you're going to examine a sample of disbursements after the year-end, January, February, sometimes even March disbursements, and look at those actual invoices and see, was this really for product from December or November of last year? Should it really have been on accounts payable last year if it wasn't? So that's the search for unrecorded liabilities. You're also going to verify dollar amounts of any large disbursements after the year end to make sure that it really was recorded properly at year end. You could have a large payable that's on there, but then when you look in January and February, maybe it was higher than what they had recorded. So that's a way to manipulate if you've understated your accounts payable. So verifying some of those large payables in the subsequent month of January and February might be a good idea. You ideally would like to compare vendor statements to the year-end balances. So when you look at those statements, does it tie out to your accounts payable listing? If you don't have a vendor statement, and a lot of times people don't, you might request them from key vendors just to verify that what they've recorded is proper. You're going to analyze and review travel and reimbursement expenses. This isn't a testing basis, but you're just trying to see if they are going through the proper policies and authorizations to before they expend and pay those travel and reimbursement expenses. You're going to review any old payables that are out there. Make sure they still exist. Because if you see something that they haven't paid in a, you know, 9 months or a year or whatever, the possibility is it got duplicated in the system. They paid one and the other one's just sitting out there. So that could be a payable that really shouldn't be there. Another thing to think along these lines are if it's a significantly large one, they may have converted it to a notes payable, so it's no longer really an accounts payable anymore. So you just might want to verify that. And that will all lead to review management's financial statement disclosures for proper presentation. What would my cycle auditing topics be without a little travel through QuickBooks? So let's look at QuickBooks so we can see, again, kind of an operational system and what's out there for the auditor. So this is the flow chart that you'll see in the QuickBooks system. It covers a lot of the tasks we talked about, purchase orders. You can either enter a bill for a service and go right to pay it, or you can enter and receive inventory and then the bill related to that. So this is all a basic flow within QuickBooks related to the procurement and payment cycle. So QuickBooks, you'll notice, does not have a purchase requisition document. So if you do have one, that's probably going to be some off the system handwritten type of document. Again, the larger systems will have requisitions and purchase orders. So from a vendor standpoint, you'll see there's a vendor center, which lists all the vendors that you've got there. It's got all the open balances for those. You can look at the transactions by vendor, but it just lists the vendor. You can fix or change the master data within there related to the vendor. You've got a bill tracker that shows the bills that are outstanding or coming due so that you'll know what your cash requirements are. You can enter bills, you can pay bills, you can create purchase orders, receive items and enter that bill, or just receive the items and then enter that bill for those received items. You've got inventory activities, you can do 1099s, and your vendors, anybody over $600 or that's an attorney, is required to have a 1099. And a lot of times, you've got to make sure that if it's an LLC, a sole practitioner, they should have one. Some of the larger corporations, like if you have a Verizon Wireless bill, you don't need to send a 1099 to Verizon Wireless. But if you got Joe's Machine Shop down the corner there that you paid $1,000 to fix one of your company automobiles, you should do a 1099 for them, since Joe is probably a sole practitioner. Quick look at the master data. So this is Toy Builder Company. We've seen them before. They have a current balance that we owe them of $33 million out there. It's got all the basics about the Toy Builder Company in there. I haven't filled everything in there, but you can see it's from Lake Placid, New York. But we could also do payment settings, where if we could do electronic fund transfers, we could do tax settings, account settings, like which account do most of the purchases from this vendor go to. Uh, those are the types of things that we will set up in the master data. So this is the purchase order that Specialty Toys sent out to Toy Builder Company, and you can see they've ordered everything from the Aha Ala cabooses to the Lulu Lusters to the Jang Jinglers, and so all these items are purchased, and it rolls up that purchase order to a $33 million total. You'll see to the right side, it's got the open balance. If there's any bills or payments, it'll show all those recent activities out there for this particular vendor. We can also enter the bill for that. In that receive and enter bill, this is kind of the same screen. So you're going to enter all those items that have been received and the amount that's on the invoice that you've got. So it's, even though it says bill, it's talking about the invoice that you received. And it'll pop up on that side as far as the right side with the vendor activity and recent transactions. So that's a typical invoice entry screen. You can also receive an item into QuickBooks by itself, and this would be the receiving screen. And like most systems, you would be entering all the items in related to that vendor's purchase order. And later on, when you decide to enter the bill, the systems will talk to each other. So it'll bring it up and say, "Hey, you've got this item receipt. Is that what this bill is for?" And then it makes entering the bill much quicker and easier. But that's the item receipt screen. So when it comes time to actually pay the bills, you'll come up with this pay bill screen. And what it's really good for is it helps you with cash requirements. How much cash do you really need? So you have the ability to show all bills, but you can show all bills that are due now so that you're only paying those bills that you really need to pay. So you've got it sorted by due date. Now it's the only bill we've got in there is this toy builder. But if I was to click that, and you'll see the empty box there, if I was to click that, it would show the $33 million that we potentially would pay in the last column, amount to pay. And that would actually deduct off of my bank account, so it would show me what my ending balance was after I paid that bill. You can see that down in the bottom in the middle. So in this particular version of QuickBooks, you've got the payment date. You can pick whether it's a check, it's an EFT, or a credit card payment. So then you're going to assign a check or whether it's going to be printed in a batch. These are options that you have. But this is a good tool to see if I pay all these bills, will I have enough cash to pay those bills? And maybe I can put some bills off, or maybe I can pay more than I have listed for today's due date. So these are all cash management decisions that you can do through this process. Usually most systems have some sort of reporting that you as an auditor would be very interested in. So QuickBooks has its vendor reports, and you can see there's a few there. The AP aging summary, that's a big deal, but you can also get transactions by vendor, see if the 1099s have been done properly. All this comes out of the vendor reports. So the typical example is the AP aging summary on your top right side of the screen. That shows our toy builder invoice for a $33 million there, and because it was a 2017 invoice in this mock data QuickBooks I've got, you can see it's a very old invoice on the aging report. And then I show the transactions down below where we had a purchase order and then we also had a bill. So this gives you an idea of some of the vendor reports. As an auditor, you're going to want some reports on check details. So that's where our cutoff tests come in. So one of the ways you can do that is you can go to reports and under banking, run off a check detail report. But you'll find that sometimes the company will have different procedures. They may not do it necessarily by check. They may be doing journal entries. So you can go to the middle of the um, presentation here and see that I went to reports and accountant and taxes. There's a couple different reports I could run. I could do a transaction detail by account, but one of the ones I like to use a lot is the journal, which is right below it. That journal will show me all the transactions. But one of the things you have to watch out for in many systems, including QuickBooks, is am I getting all the transaction types I'm supposed to get? So you can, through your filter and modifying reports, or when you're discussing this with an IT person, make sure you get the right transactions, which I want any checks or any bill payments. I may also want those journals that's in the middle of that list there included in the report that I've got related to anything to the checking account activity. So that kind of gives you a couple reports that you'll want from an auditor to verify payments. Finally, let's look at some inventory reports. So if you go to the reports section in QuickBooks and go down to inventory, you'll see an inventory valuation summary and inventory valuation detail. You'll get stock statuses by items or by vendor, physical inventory count sheet, and that's what's showed here is so that you can print off that count sheet and use that for the observation. You'll see the quantity listed that's supposed to be on hand, and then you'll put your actual count. And then you have pending bills, which is usually related to those cost rolls that I talked about. So for inventory reports, some other ones are the inventory valuation detail. You get a summary or a detail, but it'll show you the items and how their value is calculated. So in the case of the Aha a la Cabasters here, the bill really means a vendor bill. So that's a product that came in. So there's 100,000 that came in. And then an invoice was a sales invoice. So that's the 100 that went out. So that makes up our current balance of a la Cabasters there. Now, if you look at the inventory stock status item report below, you'll see the Tartingas. And we could do that for all the items. I just didn't have enough room, so I just showed the Tartingas. You'll see a reorder point of 100, a maximum supposed to be 2,000, yet we have 97,000 on hand. So obviously there was some problem in our reordering point, and that as an auditor, you might want to identify that. The sales order will reduce the on-hand quantity, saying you might have 97,000, but we've got this many that are out there on a sales order that are going to be leaving the place. So really the available quantity is what the difference is there. We'll see if we have any ordered on a PO, what our normal order quantity is, maybe even our sales per week. So it's a really good report for understanding any particular item. One of my favorite reports, and from an inventory standpoint, in QuickBooks anyways, I'll go to the item listing. So this isn't in reports, it's actually in the lists. And you go under item, and you'll see all the items that are sold out there. So I went to the Tartingas again, and you'll see the reports across the bottom of that screen below the Tartingas. So it'll do your price list, item list, and whatever, but I want that quick report on Tartingas. That's one of my favorite reports. You click it out, you see the quick report, you see it labels it as an invoice or a credit memo or what have you, purchase orders, sales orders. It's all listed there, all the activity for that item. It's great from an auditing perspective when you're looking at the transactions for any particular item. Well, that concludes our discussion on auditing the payment cycle. If you have any questions, just email me.